Welcome everyone. It's Kelley Slaught with California Wealth Advisors. So appreciative of you joining us. And we've got Dr. Joanne Feeney from Advisors Capital Management today. We are so blessed and having so much fun talking to her about the economy, especially in these days. So thank you, Joanne, for joining us. Before I hand this over to Joanne, I want to say a couple things to everyone first. So I'm going to share my screen here. So this is the evaluation form. So at the end, I would love everyone to go into our website. Whoops, I just didn't do that right. There we go. The evaluation form. Joanne, can you see that? The evaluation form? Okay, so I want everyone to go to the website, CaliforniaWealthAdvisors.com, and fill out the evaluation form for us. It's very easy, very simple. Just hit submit at the end there. And we would love your feedback. For anything that you have to say, any questions that you might have, by all means, fill that out for us. Then the other thing, and Joanne, can you see this, or my mass proprietary process here? Can you see that?
You can still see the evaluation form.
Okay, well, let's see here. I'm going to go stop share, and then I'm going to go share screen again. There we go. Okay. So the mass proprietary process here, California Wealth Advisors. So this is the world of investing here, just so everyone knows. Oops, I want to make this bigger. Okay, so here is the world of investing. So where Joanne is here is in the managed money account stock market section, this light blue section here. This is anything to do with the stock market. So up and down, sideways, the news that you watch, the Dow, that is referring to this blue section here. The dark blue section here is alternative investments. So these are anything that doesn't trade with the stock market. So illiquid types of investments, but can be very good for portfolios. I'm talking here about loan programs, real estate investment trusts that are not traded, anything over here that does not trade with the market. So why do people do this? Is because it's a nice bond replacement. And I know Joanne and I, when you listen to her later, we'll talk a little bit about bonds perhaps. But bonds are not a great place to go right now because interest rates are so low. So where do we create income? And it's largely from these alternative section of the market that we do that. So this webinar today is not on alternatives, but I do have a number of these types of webinars on my website. If you want to listen to any of those, we have those. Down here is the safe section. S is the safe money, this grayish section here. Anything that when you said, if you come to me and you say, hey, I just want the most conservative thing I can find, I want to have guarantees, I want to have an insured product, we would go down here. So this is annuities, life insurance, long-term care, any kind of an insured type of product. So as you can see, if you do all three of these sections in your portfolio, you are covered no matter what the markets are doing, which is really nice. So I wanted everybody to get that pointed out too before we started here with Dr. Feeney, who again is in this blue section here, the light blue section. Okay, I'm going to stop share, and we've got me and Joanne here. So Dr. Feeney, thank you so much for joining us today. Let me introduce you before I hand this over to you. So Dr. Feeney is a very close friend, so thank you for doing this again. Prior to joining Advisors Capital, who is one of my favorite money managers, she was a senior equity analyst for 10 years on Wall Street. She was focused on the valuation of nanotechnology, advanced instrument and semiconductor companies. So very smart lady. So we appreciate her efforts today on our behalf. Dr. Feeney worked as a consultant for the World Bank, also a consultant for the Federal Reserve and the International Money Fund. So as you can see, very credentialed friend and associate of mine. Very much appreciate her being here with us. So as you guys have questions, by all means put them in the chat. I will read them off to Joanne as we go. And with that, Joanne, I'm going to make you the host so you can do your slides. I think I'm going to make you the host. Let's see. Maybe I'm not going to make you the host. All right, let me think about how I need to do this. More. Okay, I'm not seeing this.
If you click on participants.
Ah, there we go. I need to make you the host. There we go. Make host. Sorry about that. I messed up there a little bit, but there we go. Change host. Okay, you got it. All right, off to you. You do your presentation. Thank you.
Okay. Well, thanks again, Kelly, for inviting me to do this with you. It's always a pleasure to work with you and to talk to your clients. I've been out there and done this in person. I miss being able to be out there this year. Unfortunately, COVID is getting in the way. But thanks for that introduction. I'm a partner and a portfolio manager with Advisors Capital Management. For those of you that don't know me, I manage our balance strategy, which is a mixture of equity and fixed. We have team members here at ACM. We don't work individually. And I have a fantastic colleague who manages the fixed income side along with my collaboration. I also manage our growth strategy, which is 100% equity, a bit more aggressive, as the name suggests. And also, of course, tends to be a bit more volatile. So a lot of folks come to balanced because it's a more conservative selection of equities. And we offer options for clients to target yield on both the equity side by selecting stocks that offer different levels of dividend yield, but also on the fixed income side, where we can actually select investment grade bonds, investment grade preferreds, or high yield bonds and unrated preferreds to get a little bit more income. Now, Kelly mentioned that, hey, fixed income is not a great place to be right now. You know, the treasury rate on a 5-year treasury bond is less than 0.5%. Doesn't sound very good. But by selecting carefully corporate bonds and preferreds, we're actually generating about 2.5 to 3% yield in our core balanced strategy, which is called T3 for like 3% yield. But we could also get 4% yield or even 5% yield by, again, changing that selection of equities and fixed. So all is not lost in fixed income, even with interest rates as low as they are. And as you know, and Kelly, I'm sure, is very aware of this and is telling you guys this, fixed income can be a useful bit of stability in a portfolio and can make you comfortable with putting some of your money in equities to get the appreciation that only equities really can provide, along with the alternative assets that Kelly offers through her services. So, you know, it's still, we believe, still a very valuable part of a stock and bond portfolio to have some invested in bonds. We actually have a default mix of equity to fixed, which is 70% equities and 30% fixed. And so our different balance strategies, T3, T4, T5, you can target yield, and you get that roughly the same yield on both sides, equity and fixed. So you can change your mix. If you don't want to be 70-30, you can be 50-50 or 40-60 and still be targeting the same amount of income. So it really gives a lot of opportunity for Kelly to work with you to figure out what's the appropriate level of risk to be taking in the equity markets, how much income do you guys need to have, and then how much potential appreciation are you building into that third of the offerings that Kelly provides for you. So Kelly invited me here to talk about the current environment for investing and how the economic dynamics play into that, and also the political dynamics. So I've put together some slides. I'm going to show those now, and I'll start going through those. And don't worry, not a lot of math, even though I'm an economist. Not too many charts, just enough. And then Kelly, I'm sure, is going to interrupt and feed me your questions along the way. So hopefully this will be entertaining as well as informative. Because I know now a lot of clients are talking to me and they're saying they're a little bit nervous about how high the market has gone, about all the uncertainties out there in the economy, whether it's COVID related and shutdowns happening and then not happening, whether it's the election coming up, the trade war with China. There are just a lot of sources of uncertainty out there. And so I'm going to try to walk you through some of those and then how we are responding to those. So let me share my screen. And there we go. Okay, you should be able to see that now, yeah?
Yep, looks good.
Okay, perfect. Okay, so we are in a very different world. Not only has the coronavirus disrupted business activities and consumer behavior, but it's actually also engineered a rapid change in how people live and how firms are operating. And both of those things obviously cause a massive disruption in March when the economy virtually shut down. And now that we are out of the total shutdown phase, we are starting to see a more permanent change in consumer and firm behavior that really plays into how we're choosing our investments. Okay, so first of all, let's look at a basic measure of the health of the economy. We like to look at unemployment because it's the cleanest look we can get. It's the number of people simply out of work, at least at a high level. And as you can see, we had this unprecedented spike in unemployment, up over 14% back in the second quarter. And that's now come down quite a bit from there. Now we're down around 8.5%. But this is just one measure of unemployment. There actually is a fair bit more unemployment than this chart reveals, because there are folks that have simply dropped out of the labor market at this point. There are also folks who are filing for unemployment claims specifically through the pandemic unemployment relief fund. And so there's actually more unemployed people. We're somewhere around 30 million people who are continuing to file unemployment claims. And just to give you a sense of how big that is, the total population in the US is about 330 million. And the working population, when you take out kids and retirees and people on disability, et cetera, is, it's a pretty big number, the proportion of eligible to work people. Okay, so that's going to take a while to recover from. So let me just set expectations. Some people are asking what the shape of the recovery will be. Unemployment dropping as much as it has here is helpful, but it always takes a long time for this amount of unemployment to resolve itself. It takes years. When we look at previous recessions, we know this is going to take a long time. So let's be prepared. Number two, well, we had the virus, and this is a chart here of the TSA checkpoints at airports. Obviously, you can see the blue line is 2020 relative to the orange line, which is 2019. So we saw basically drop down to about 80,000 people traveling in late March and early April relative to a more normal level of between 2 and 3 million. That's just, unprecedented, right? And obvious given what happened with this pandemic. Now we've seen it come back somewhat. We're still now between 500,000 and 1 million, but still we're way below normal times. And so of course the airline industry is suffering massively, but everything associated with travel is also suffering. All those stores at the airports, all the coffee shops, right? All those restaurants, right? They're all suffering as well. And then travel booking agents and booking websites are suffering. So this really continues to pervade the economy, this big headwind we have because of the pandemic. And we can look beyond airports to communities, restaurants. And this is data from OpenTable, which tracks, of course, reservations and seated diners. And what we saw there was a drop. And this is an index, so 0 being normal, minus 100 being minus 100%, so 0 dining. And so during the shutdown, restaurants were virtually closed. This is some state-by-state data. So these are the largest states. And you can see how much that fell off a cliff in, again, mid-March to late April, but it's starting to come back. And it first came back with outdoor dining. And then as states got the virus in their rearview mirror to some degree, or at least as the number of cases came down, like it did here in Jersey and New York City and Connecticut, then there was an allowance for indoor dining. And so at limited capacity, for example, New Jersey is allowing 25% of diners inside the restaurant relative to their entire number of tables. So we're starting to see that come back, but we saw that after that increase in June to the beginning of July, we saw that really flatten out because the COVID case spike came back in July and August. As states did reopen, we got more virus transmission. And so diners didn't have to wait for the government to say, no, you're not allowed to go out and dine. They basically said, we're not going out, right? There was just a whole full stop in the increase in the number of people willing to go out and eat in restaurants, even with outdoor dining through the summer. So the right-hand side, though, shows some of the recent increases in indoor dining that have been allowed. What happens from here, though, is really going to depend on the virus. And there's a lot of concern enunciated by some of the experts like Fauci and some of the other folks Gottlieb has been on TV a fair bit talking about this. There's a lot of concern that the virus is going to spike again in the fall and the winter as cold weather comes in, and as you end up with people going back to school and people staying indoors more. So there's some concern about how much the restaurant business can really recover. And again, another thing we're taking into account in our investment strategy. Another measure of people, though, returning to activity is the change in gasoline demand. So notice it fell off a cliff there in the third week of March, dropped down from, basically 9,000 to, 4,500. So dropped in half, basically. But now it's come back a fair bit. And you might think, well, is that a sign things are getting back to normal? Well, there's a couple things going on here, right? One, this is the summer. So gasoline demand normally rises in the summer, and this chart only stretches back to January, right? So we saw, last summer, that was January 2019. We saw last summer we got up to around 10,000 here, and we're still about 10-15% below that. And so what this is telling us is that while people are returning to their cars, we're not coming back to last summer's level. And there's a couple reasons for that. One is people still are not returning to work. They're still working remotely to a large degree. And so you don't have that commuter demand for gasoline. But what you do have are people taking vacations. And because they don't want to fly, right, they're taking more car vacations. And so some of that increase in demand is leisure travel through the summer. Now, as we get into back to school times, right, this month, and as you can see, that started to tail off again. So it could very well be that we'll see gasoline demand fall again, and with folks working from home to a large degree, with kids back in school, the summer driving demand will fall off again, and the commuting demand for gas probably doesn't return. I think a lot of firms are still saying to their workers, yeah, you can continue to work from home. We are doing that at ACM. We have decided that we're not going to make another decision about this until at least the end of the year. So for now, we've told all our people work from home, which, by the way, works out very well for us. And it's seamless from Kelley's perspective as an advisor. Kelley, you don't know that we're all working from home. You just pick up the phone, you call, and somebody answers.
Very true.
So it's actually working quite well in our industry to work from home. But that also influences our investing decisions. What kind of stocks, what kind of companies rely on commuter traffic besides gasoline? Well, folks aren't going into New York to work as much, so they're not going out to have business lunches, right? They're not having business cocktails at the end of the day. They're not working out at the gyms, even if the gyms are opening to some degree, because they're staying at home. Okay, another measure, though, of some return to normal, and also that picks up that commuting problem I just mentioned, is this mobility tracker from Apple. And what we're seeing here is that people they're getting out of their houses, but they're doing it by driving and walking, right? They're not returning to public transportation. Not only are they not getting in their cars to commute, but they're certainly not enthusiastic about getting on trains or buses because of the spread of potentially the spread of a virus in an enclosed location like that. And they've read the articles of various case studies of people that got on buses. One person was infected, 50 people got it on a 2-hour bus ride. So people are taking note of that data and are saying, I'm working from home, I'm not going to get on public transport, and that has implications for investing strategy. Okay, yet look at the market. Now it's sold off a little bit here in the last few days. It's doing okay today. But what we're seeing here is the recovery, it seems, in the stock market. But that doesn't tell the whole picture, and I'm going to talk a little bit more about the nuances a little bit later. But just look at how much the market has recovered. And so you have to ask, boy, there seems to be a dislocation between the market and what the economy is doing. 8.5% unemployment, that main published number, and yet the market is back where it was when we started the year, or close to it. And that just doesn't seem to be consistent with this big economic challenge we have. And so really what we want to find out is what's underlying this, and should you guys be worried about the market having risen this much is it time to maybe back away from equities? I'll give you the answer right now, and the answer is it depends which kind of investments you're in the market, because we do see some things as overvalued here that have really pulled this market higher. And the key things that have pulled the market higher are some of the biggest companies like Amazon, Microsoft, Google, Netflix, Apple. Some of them we like, but some of them are just too expensive, and there's better ways to play this. Okay, so
I
now
would
what?
interrupt you just 1 minute just to point out to everyone, and I'll bring this up at the end as well. The reason why I love Advisors Capital Management as well as Dr. Feeney is because they buy individual stocks for portfolios. So as she says here, there's things that are overvalued that we're not in, that perhaps you were in back in January. And that's wonderful that you guys can get out of things. You're not in mutual funds. Mutual funds, you can't do that. You can't pick and choose where you want to be specifically, whereas Dr. Feeney can, and her team can. They can buy individual stocks for portfolios, so they're very malleable and take advantage of these markets how they are. Now, many of you that are on the call here are in Advisors Capital Management with me, and you saw a downturn, obviously, in the markets, as you can see in the downturn in her chart here, but has come back quite a bit, and many of my clients are up in the market now because Dr. Feeney can go and take people out of stocks that aren't performing as well, or she doesn't feel like are going to rebound with the market as she sees it. So I just wanted to point that out. This is why Advisors Capital is so much better than many other money managers out there, because they're buying individual stocks, they're not buying mutual funds. So they can take advantage of these changes in the market that happen like this. So anyway, I just wanted to point that out. Dr. Feeney, go ahead.
Yeah, thanks. In fact, Kelley, that's how we're able to deliver those different yields in the T3 version of balance, the T4 version, and the T5, is we're pulling out different stocks from the market to achieve those dividend yields. And the same thing on the bond side. We don't own any bond funds. We don't like them because you're locked into owning too many things, and because the fund sells bonds on a clockwork basis in order to achieve a given maturity, which is advertised as part of the fund. We don't have to do that. We can own individual bonds. We can hold them to maturity. So we don't have to suffer a price decline on a bond and lock that in for a client. We can choose to hold them to maturity if that's the better strategy. So yeah, that individual bond selection, individual stock selection really gives us a lot more control over yield. And it gives us an opportunity to go to places in the market where things have sold off, where we think they'll have a chance of recovering as the economy starts to do better. So what now is the question? What's going to happen in the next 6 months? We're sitting here, it's September. We've had this big bounce back in the market. We have some stocks that are, I think, really undervalued here and overvalued. And so obviously we need to think about the economic recovery, right? The W, what's the shape of the recovery going to be? You know, we might have had somewhat of a W so far, a W saying, oh, we could have another pullback, both in the economy and in the market. You know, we could have something where we go down and stay down for a while and eventually recover, right? Or we could have the Nike swoosh where we go down sharply and it's a really, really, really slow and gradual recovery. This is the kind of shape that most recession recoveries follow, is the Nike swoop. You go down fast and up slow. So it definitely requires patience on the part of investors and some you know, strong stomach to be able to handle the fact that their portfolios are down and then wait it out. So time horizon really matters, right? For the mix of those alternatives that Kelley has presented to you, those 3 buckets that you could be in. This K-shaped recovery is something that's sort of new. It's a recognition that the impact of the coronavirus is really different depending on where you are in the economy. Like, our firm is continuing to operate. We're all still employed. We're in fact busier than ever. And so we're doing just fine. There was a bit of a blip as the market went down, right? But the market's recovering. Our client portfolios are recovering, right? But there's a part of the economy, particularly in the services industry, where people are unemployed and their prospects for reemployment are really, really bleak right now. And it tends to be the lower end of the income distribution, which is being hit the hardest by this virus. Restaurants are closed. Hotels are closed or are at 5% capacity. People aren't flying on planes. Bars are closed to a large degree, or they're open with really, really limited offerings. So the lower end of the income distribution, the people that are in the service sector, right, really are suffering, and their situation is getting worse because now the transfer payments from the government have stopped, right? That $600 extra a week in unemployment insurance now is, in some cases, states are now providing $300 a week or nothing at all. And it doesn't look like there's likely to be another fiscal stimulus package here anytime soon. And so they were helped during the summer by the stimulus or relief package, and now there's sort of nothing on the horizon. So their situation is getting worse. Folks that rent apartments don't have the same deferment of their rent like a mortgage holder will. Mortgage holders are able to say, okay, I'm not going to pay my mortgage for the next couple of months, and it gets tacked on to the end of the mortgage 20 years from now, 30 years from now. A renter may not have to pay right now, and they won't get evicted, right? There's been a moratorium on evictions, but they're going to have to pay by the end of the year. And so they're really going to struggle. So how does that affect the stocks that we own? That disparity in how this is affecting different parts of the income distribution. Again, these are all things we take into account when we're trying to figure out what stocks to own. Okay, now we are in a recovery, right? Unemployment has gone down. GDP growth this quarter should be 20 to 25%. So we're going to have a nice bounce back. So maybe we're seeing the beginning of a little bit of that Nike swoosh, right? We're getting things back in order. Businesses are reopening. Kids are, to some degree, going back to school. People are going back to work. There are risks, though, over the next 6 months. We're sitting in September. We're now on the cusp of fall, deep fall and winter. And there's a lot of concern that the virus could surge. And that could potentially lead to renewed shutdowns. Or it could simply mean that restaurants have to shut down their outdoor dining. Up here in the Northeast, not like where you guys are. You know, in the Northeast, you can't keep restaurants outdoor dining open for too much longer. It's starting to get cold. And so we have to take that into account. The other concern that people have, I mentioned before, has the market gone up too far too fast? Is there any kind of a bubble here that we should worry about? And then besides the coronavirus, besides the depths of a recession or depression that we're in, there's still this China trade war that the administration is pursuing. And so how does that affect the opportunity for companies to sell their products abroad or to get supplies from China because they build things that use stuff that's made in China? And so that China trade war is fundamentally affecting a cost of doing business and companies' access to markets. And then we also have the Federal Reserve. The Federal Reserve changed its rules about how they were going to pursue their mandate. And their mandate involves maximizing employment and keeping prices stable. And they made clear that, hey, you know what? Our price target, our inflation target was 2%. We're going to target 2% inflation. Right now, we're running, half that. But now they said, you know what? We're going to let inflation run a bit above 2% because it's been running below 2% for the longest time. And we think there's room for inflation to rise a bit higher without getting out of control. And instead, they're going to focus on doing things that will boost employment. So that's a tailwind for the economic recovery. That's a good thing. But it does mean that because interest rates are going to stay low, the Fed's main tool, right, is the federal funds rate. And they basically said, we're not going to raise the federal funds rate. And right now, by the way, it's about 0. We're not going to raise that till probably at least 2023. So really low interest rates. The federal funds rate, which is what the Fed controls and influences, feeds into all other interest rates in the economy. Treasury.
Joanne, can I interrupt just
corporate bonds
here? Let me ask you a question here. So as far as interest rates go and them rising quickly or taking a very long time to increase, my view is that the national debt is very high, as you know, in the trillions. And if they increase interest rates quickly at all, that national debt will increase hugely, very quickly. So they kind of have to keep interest rates low, which for folks looking for income is a challenge, certainly. But what do you think about that? What do you think about them raising interest rates and national debt and all of that?
Yeah, so yeah, the low interest rates have really enabled the fiscal authorities in the government, the federal government, to be able to offer these relief packages at very low cost, right? They're borrowing very cheaply. If interest rates rise, the debt service, the interest costs of the debt go up. Now, when the the fiscal government side of the business of governing borrows, they do borrow longer term, right? So that's why you have 10-year treasury bonds, right? They're even considering doing potentially, 50-year treasury bonds. So there is some protection there that the interest burden of the debt wouldn't rise so quickly, even as interest rates go up. But be aware, right? The Federal Reserve is an independent central bank. Their choice of interest rate policy is entirely separate from what's going on in terms of the federal government and what they do, right? They are not part of the federal government. So their only goals in setting interest rate policy is their dual mandate: maximize employment and keep prices stable. They don't have anything in their policy rules that reflects the government deficit or the debt. It's like doesn't exist for them. So they're separate entities, which is good, because otherwise we could end up like Zimbabwe and have money being printed to finance the government debt. That doesn't happen in this country, right? They're completely separate entities, which is good. That's why we have such a stable money supply in terms of prices and interest rates. And right now we're in a world where interest rates are low everywhere, right? There's just not a lot of demand to borrow for investment purposes for companies, right? They're borrowing to get over the COVID crisis. They're borrowing to some degree to buy back shares. But investment right now, real capital investment, new facilities, right? New equipment, that's really depressed right now. We're just not seeing a lot of demand. And that's one of the reasons why interest rates are staying so low, despite how much the government is borrowing. And so we don't anticipate that changing. And the Fed is saying that, look, our view of the world is interest rates aren't going to rise for a while. And so to your point, how do your clients deal with that? Well, we handpick bonds and preferreds to try to generate some decent yield, 2.5% to 3% on our T3 balance, or maybe even 4%, or just shy of 5% on our T5 balance. So handpicking bonds can get you more yield, but the higher the yield, the more the risk you're taking, right, even in bond world, because corporate bonds aren't as safe as the treasury bond. And so to get some yield, you do have to take a bit of risk. So, we'll see how effective the Fed can be. They have a limited arsenal of tools to try to boost employment. Keeping money cheap is one way they do that. The other big risk, obviously, for the fall is the election. And, the polls are suggesting that it's better than a 50-50 chance that the Democrats actually sweep, that is, win the presidency and win the Senate and retain the House. And if that were the case, it's more likely that the Democratic platform, which involves a higher corporate tax rate, moving from 21 to 28%, other capital gains taxes going up, various other changes in rules, are more likely to occur. It's not, I wouldn't say it's a fait accompli, but to your point, Kelly, about the debt, at some point we have to stop running these big deficits and pay down that debt. And so at some point, taxes do have to go up. I don't think anybody would be enthusiastic about raising personal taxes during a big recession. And so let's, though, put that off. I've got a slide later where we'll look at some of the details of what could happen under a Democrat sweep to tax policy and how that might affect the market. But this is a risk that we're keeping our eye on. And again, we're responding by adjusting our investment strategy. So let's look at those risks one at a time. Obviously, potential additional surge in coronavirus cases in the fall and winter. That has a lot of people concerned about renewed shutdowns, pulling back from this economic recovery that we're starting to see in terms of GDP and business activity. That's a risk. What we're doing is saying, you know what? It's too early to invest in the companies that have gotten most beat up because of the pandemic. Movie theaters, cruise lines, airlines, some kinds of restaurants, gyms, right? Workout facilities and real estate properties that own workout facilities. So we think these COVID central names are still really vulnerable, even though their valuations look really attractive. Some of them are down 50%, 60%. But if you're going to get a second wave, then the enthusiasm of the recovery this summer, the enthusiasm about, hey, maybe there's going to be a vaccine, or hey, the case count is starting to fall, or hey, the death rate is starting to fall, that enthusiasm has pushed some of these stocks up. And some people might say, well, hey, get those before they go up any further. Our view is there's very likely to be a second wave, as some call it, or a surge in the fall and the winter, and those kinds of COVID central names will pull back again. So let's not go there yet. They're extremely cheap. They'll still be cheap when we get to January or February, right? Then there's the economic recovery stocks that are in the middle of the market. And what this chart shows you is the disparity between the S&P 500, the headline that everybody looks at and everybody says, hey, the market's recovered, and a different way of looking at the 500 stocks of the companies in the S&P. So the red line is an equal weighted version of the 500 stocks in the S&P 500, whereas the green line is the way the index is actually calculated, which takes each stock of those 500 companies and gives them a weight equal to their market capitalization. So the biggest companies get the biggest weight in the index. Apple, Amazon, Microsoft, they're all over 5%, each of them individually. Google is over 6%, right? And so the moves in those stocks just dominate the index, right? I think it's like the top 5 or 6 stocks in the index accounts for 25% of the index. So if those stocks are up a bunch year to date, and they are, Apple is up, for example, 50%-ish, a bit more than 50%. That's dragging up that green line. That's dominating the index. But if you look at the average stock in the index, it's still down 7, 8, 9% year to date. And that tells you what's going on really in the market. Like where are most people invested? They're invested not in the top 5 names. They're invested more in a more diversified way, which makes sense because, these multiples on some of these high-flying stocks can change overnight if there's a little bit of a change in expectations. And we saw some of that over the last few days. Okay, so when we look for stocks to invest in, we're looking at these 3 buckets. The COVID central names that I mentioned, those are the ones that are down 30, 40, 50%, even more still, because everybody's like, this isn't over yet. I don't want to invest there. Then you've got the other end of the spectrum, the high flyers. These are companies that are actually benefiting from the change in behavior of consumers and firms because of COVID. People are working at home. People are staying in and they have to get their entertainment at home. So they're doing more Netflix, they're doing more video gaming, they're buying more computers, they're buying televisions. Firms had to ship their people computers and printers, and they're using the internet a lot more. So companies like Microsoft, for example, selling software, they're doing great. And they're likely to continue to do great because they have so much recurring revenue from all those software subscriptions. They also provide some of the infrastructure for the internet, right? They provide cloud computing services, more recurring revenue, and the demand for that is going through the roof as more people work remotely. All the data flying around the internet is just increasing at a much faster pace than we expected it to before this all started. Amazon is another one. Not only, of course, all the online shopping that people are doing, but also because they also provide cloud computing services through Amazon Web Services, it's called AWS. And that is being accessed more and more as companies work remotely, as people work remotely. So this is an acceleration of the change in the economy to online shopping, to more and more internet, to more entertainment at home. It's an acceleration of a change that was going on anyway, but it's as if 10 years worth of change has happened in the last 4 or 5 months. And so there's a legitimate reason for some of those companies to have gone up because the expectation for future growth is so much higher. But again, we like to be careful about where we invest. We don't want to pay too much to get the same kind of growth. So the question that we get a lot is, but has the market gone up too much? The high flyers have gone up. Some of them, I think, are worthy of the price increase. The COVID central names have gone down. And then you've got stuff in the middle. Okay, that's the third bucket that we look at. The stuff in the middle are companies like banks, for example, or some packaging companies, or some clothing suppliers, or housing suppliers, housing builders. These are companies that benefit from the economic recovery more broadly, particularly banks. And so because we're only at the beginning of the recovery, a lot of the bank stocks are still down 25%. Because they really need for all of economic activity to recover. And that's where a lot of the value is. Because we've seen economic recoveries in the past. We know they're a bit uneven, but some of these companies pay 3, 4, 5% yield on dividends. And in the meantime, you've got an outlook over the next couple of years where you're likely to get significant price appreciation. And so this is an awfully good place to go for both income and for appreciation over the next 2 years. This is a situation we're in where there's a lot more near-term uncertainty than long-term uncertainty. Near-term, all those risks I mentioned. Long-term, we get a vaccine. Most likely, we get a vaccine, right? People can get back to normal. The economy can recover, right? And so long-term things look a lot more predictable than near-term. And so those names in the middle, the names that depend on economic recovery, that are down way more than the average stock in the market, those are the ones that have a real chance of a significant upside over the next couple of years.
Yeah, so let me bring up here. So many of you on the call here have investments with Advisors Capital Management that are a balanced portfolio. They have income and as well as growth in them. So they haven't recovered quite as much as some of the more growth-oriented portfolios that Joanne does for us. So speak to that just a little bit as far as those coming back. They haven't quite come back yet, but as you just said, it's because that industry hasn't recovered as well yet, but you do expect that to come back eventually as well. So just speak briefly to that if you wouldn't mind.
Yeah, exactly. So, right. So when this came across, we did make some changes early in March to get out of the COVID central names, but in balanced, when we're looking for dividend yield, a lot of times the companies that pay higher dividends are the companies that aren't growing so much. They're not the companies that are benefiting from this change in behavior, like an Amazon. They don't pay a dividend, zero, right? So you can't own an Amazon and get any kind of yield. So an income-oriented strategy, and you'll see this across the board. You can look at an index from the S&P 500 of their high dividend stocks. They're down like 28%. Right, and they still are. But the reason why we want to stay there, right, even though they're down, is because they're paying a nice dividend. If I look at some of these stocks, Citigroup 4.5%, JP Morgan, close to 4%. You're getting paid to wait. You're still collecting the income, and because these are the sort of stocks and companies that recover with the economic recovery, you've got this period of what we think will be about 2 years where you get outsized appreciation on those stocks. So we're delivering the income, right, that clients often are living on in their retirement. And we're sitting in positions where we think there's going to be outsized appreciation over the next couple of years. So yeah, it's been kind of painful and it's often confusing for clients that are in balance. They look at it and they say, hey, I haven't kept up with the market. And I say to them, yes, you haven't. And that's because of the income we're generating for you instead. And because the appreciation for your portfolio is coming in the future. It's coming as the economy recovers. The market that people look at, this S&P 500, is very misleading. It's really these 5 stocks that are dragging the market around. And you say, well, why don't I own those? Well, first of all, they're not going to give you income, right? And they're really volatile. And so what we like to do is say, here's your income, hold on to that. It makes it possible for you to wait for the market to recover. And by the way, you're in stocks right now that are down 25, 30%, think about how much recovery potential, think about how much appreciation potential is sitting in those stocks. Because banks aren't fundamentally broken. This is not like the financial crisis where we had to go in and re-engineer the financial system to fix how banks work, to change the way contracts were drawn, right? There's nothing that's broken in the economy. It's just a matter of waiting till we get a vaccine for people to get back to normal, for people to be able to be re-employed and work shoulder to shoulder in factories and in restaurants and at amusement parks, right? And so that'll happen over time. So those income-oriented strategies like Imbalance are ones that definitely are lagging the market, partly because there's also fixed income imbalance. So we're going to lag the market just because of that, but also because we are staying in things that are delivering higher than average yield and that have a lot more appreciation potential than the market does over the next 2 years.
Yeah, I'd like to equate this, if you don't mind, with going back. I know I talked to you in maybe, I think it was May, Joanne, you and I had a conversation about the markets and what was happening. And we were down in most all of the portfolios we had. And because I have a plan and I have a clear view for each client individually where we're going, I didn't allow anyone to panic. I didn't panic with selling anything or liquidating anything at that time, which would have been a horrible time to do that. And so as we waited, because we had a plan and we knew what our plan was, we stayed with it, and subsequently it's recovered. Same thing I think is happening here with the income-oriented portfolios. We're not panicking and selling out of something right now just because they're down. We have a plan. As you say, they create income, which is what most of my clients are in those portfolios for. So that is still being generated, even though the value per share on some of the stocks in there might be down. But this is, again, we're not going to panic here. We have a plan. We're going to stick with it. Obviously, Joanne and her team are coordinating the different stock positions each client owns to take advantage of any kind of benefits they might see in the market, as she said. So I think I just wanted to bring up to all my clients here that we don't panic in the markets. When we have a plan, we stick with it. We allow the money managers like Dr. Feeney and her team to manage through these markets. That's what they're good at. Let them do that. And that's always been my attitude with the markets. You've got to have a plan and stick with it no matter what the markets are doing, because they will recover at some point. And especially if they're managed well, like Dr. Feeney does, then we'll eventually come out being fine on the other end. And there's reasons why they do different things, as she states here. So anyway, I just wanted to bring that up for the income-oriented folks.
Yeah, Kelley, in your job and in trying to help clients through that, the value of that is on this current chart, right? What this chart shows is that if a client had missed only 5 days, the 5 best days in the market over the past few months, right? This only goes through, I think, early July. But if the client had panicked and had gotten out of equities and gone to cash, right? Or if they had just missed the 5 best days in the market, look at the difference in where their portfolio would be now.
That's
right?
huge.
And so staying with the plan is so critical. And Kelley, that is probably one of the hardest things about your job. And it's the hardest thing for clients to do, is to just hold, take a breath, relax, and say, I'm not in this for this year. I'm in this for the long term. I'm getting my income. I'm not going to panic, because look what happens when you panic. People lose money because they panic when the market's down, and then they miss the recovery. And it happens over and over again. And that's why individual investors that are managing their own money, their average return in the stock market over 20 years is a return annually of only about 2.5%.
Right.
Whereas the equity markets on average over the last 20 years have generated about a 9% return. And the reason why the individuals do so badly is because they panic and they sell, and then they don't know when to get back in, and then they miss the recoveries.
Yeah, it's emotional. Yeah, I always tell my clients,
emotional.
it's not emotional. We're not emotional about this. Don't panic with whatever the news item of the day is.
Right.
So
Just don't watch the news. Just
yeah, just don't watch the news at
turn it
all.
off. Yeah, I have to watch the news. It's my job. You guys don't have to. Right. And so it's important to stay invested, really critical, especially in these really rapid market gyrations. The other risks we're worried about for the fall here is the trade war. And I'm not going to spend much time on this, but it's out there as a concern for the cost of doing business and market access, and something that we're taking into account. Now, Main Street is really suffering, right? Shops are still closed. Business is still down. In fact, retailers, to some degree have missed the opportunity to prepare for further sales that did occur early in the summer as folks went back out after the virus subsided a little bit. And so there's still an awful lot of Main Street pain out there, and that is affecting certain businesses. Okay, let's think about that election risk I mentioned before. So here's an analysis that shows the potential impact to the earnings of the S&P 500 companies. So under the current set of tax rules, it's expected that in 2021, the S&P 500 earnings per share of that group of companies would be $170. Now, if the corporate tax rate is increased from 21 to 28%, that reduces those earnings by $9. Okay, that's the first light blue bar there. Other tax increases bring the total to about a potential $20 hit to that $170 in earnings. So about 12% reduction for 2021 earnings if two things happen. The Democrats sweep and the Democrats themselves all agree that it's a good idea to raise all of these taxes in the middle of one of the deepest recessions we've ever had. So it's not clear that that would be the case, number one. And number two, the polls are currently saying that there's a better than 50-50 chance that the Democrats will sweep. And investors aren't stupid. So there's already some expectation that taxes are going to go up. And so if the hit to S&P earnings is 12%, but it's already a better than 50-50 chance that the Democrats sweep, and maybe you give it a high probability that if the Democrats do sweep, they do get all this stuff enacted, then some portion of that $20 hit is already based into expectations, right? So is it that big a risk that we should even worry about it, right? Because if half of it's already built in, then we're talking about a 6% hit to EPS. And that would mean a 6% decline in the S&P 500 stocks. Well, that's not a lot, right? Given that we have seen this massive appreciation in stocks, right, over the last few months. And generally, when economies grow, and especially during an economic recovery, stocks tend to go up as the recovery proceeds. So it seems like it might be not the wisest thing to try to get out of equities to avoid this election risk, because then you're giving up appreciation because of other things, because of economic recovery happening, just because you fear that, hey, the taxes might go up and that could have a 6% further hit to the market. So it's not clear whether you should even try to avoid this election risk because of that timing problem. When do you get out? When do you get back in? Could there be a vaccine announcement in that time when you're out of the market? Because that could cause the market to go up 5 or 6 or 10%, right? So it's always tricky to trade around events. We try not to do that. What we can do, though, is hedge. And so one way to hedge the election risk is by owning more international companies. And we do have some of those in balance. In fact, almost all of our strategies have international positions. In fact, we have a whole strategy just for international. But in balance, for example, we have some international stocks, companies domiciled for their tax headquarters in foreign countries. We added one recently called Train Technologies. It's actually a Minnesota company, I think, or Iowa, sorry, an Iowa company, but it's actually got its tax headquarters in Ireland. And so they wouldn't be subject to the tax increase. And we have some pharmaceutical companies that are foreign companies, so they wouldn't be subject to the tax increase. So one way of hedging a little bit is to own some international stocks. So we own about, I guess, somewhere between, I think it's like 7 and 14% of our equity in balance is allocated to international companies. So that's one way of reducing some of that exposure. But again, I just don't, it's not that big a deal, given where the market already is in terms of assessing the probability of a Democratic win, and where we should realistically expect any tax changes to go. But that doesn't speak to individuals and capital gains taxes, right? If the capital gains tax goes up, there might be an argument to be made for individuals to start taking those gains this year. Because if they're in a concentrated portfolio, if you have a stock because you worked for Qualcomm, or you worked for Hewlett Packard, or you worked for whoever is around your neighborhood, you might have accumulated a lot of stock in that company, and it might be a disproportionate share of your stock ownership. Maybe if 30% of your stocks are in one company, you really need to diversify, and better to start doing that this year if you anticipate the capital gains tax will go up next year. So that's something that all advisors, I think, that conversation will be had, depending on the outcome of the election. Something to consider. And that's what this stock is about. You've got this slide that you've got these built-in gains from old legacy positions, and it might be time to think about making sure you're diversified, making sure if you're going to take capital gains, you might want to do them before the election outcome, because once it happens, people will raise the probability of that capital gains tax going up, and that could put some selling pressure on these high flyers, particularly the really big winners this year, like Amazon, for example, or Netflix or Facebook. And so that's something where people have concentrated positions they really might want to lighten up on, but that could mean downward pressure on those stock prices before the end of the year. Okay, so, as I said, we are thinking of the world in three buckets: COVID central names to avoid, high flyers to be really selective about. We like Apple, we like Microsoft, we like lesser known names that are also really involved in this transformation we've seen of consumer and firm behavior, like a little company called Zebra Technologies. I'll give you a little story. Amazon, we know, has been doing well with all the online purchases. Well, if Amazon is the great white shark, Zebra is like the little remora fish that clings to the great white. The more the great white eats, the more Zebra eats. Zebra makes handheld barcode readers that are all over the Amazon warehouses. So the more business Amazon does, the more barcode readers they need from Zebra. And Zebra is supplying those barcode readers not just to Amazon, the U.S. Postal Service, to hospitals to track patients, to sports teams to track their players, and to firms now to track their employees to make sure they keep on top of the COVID spread. So nice diversified company intends to grow when Amazon grows. In fact, over the past few years, Zebra stock has outperformed Amazon stock. So you don't have to own a company like Amazon trading at 65, 70 times next year's earnings. You can own Zebra that's only trading at 20 times next year's earnings. So we like bargains at ACM. So we do analysis like for Zebra. We look at the balance sheet, we look at debt maturities, dividends, all of the details to make sure that we know the risks. And right now we're going to be conservative because there's so much uncertainty from COVID, from the pace of the recovery, from the election, right? We just want to be more conservative than usual right now. And so,
let me bring up here, since this brought it to mind, your Zebra story here, which is a great story. That you guys at Advisors Capital, this is one reason why I fell in love with you guys. You actually really research each individual company that you own. I know I've heard stories from past Advisors Capital folks I've talked to that you actually go to the companies and travel around the plant or see the properties that they own. Depending on the stock. I love that you guys do that, because as my clients know, I do such a deep dive into anything I recommend to everyone. I get to know CEOs of companies and what their track records are and what they think. And I really appreciate that you guys really look into each individual stock that you own, which again makes you stand alone in the industry of managing money, because most money managers most money managers manage other money managers. They manage mutual fund portfolios, which you can't do that. You can't give that kind of personalized care to each individual stock you own when it's a mutual fund portfolio. So I just wanted to bring that up to folks to give you credit, Joanne, because I know you guys do that and really do a deep dive in each individual company that you own.
Yeah, thanks, Kelly. You know, we also, because of that, we own only about 40 to 50 stocks in each client's portfolio, right? We want to know them well. 40 or 50 stocks gets you enough diversification, but it enables you to do that thorough level of research and be able to change things rapidly. Changing a couple companies can change the face of the portfolio strategy for the client. Okay, so that's about it. I didn't have anything else to add. I just think, these are tough times. It does require a lot of patience, and that means, Kelly, that I'm sure you're getting a lot of phone calls and having to coach people through this. But it's tough. This is a period of unusual risk and uncertainty, but it's also an opportunity period too, because there's so many stocks that have yet to recover. And that's what we're trying to do in balance and to some degree in growth, to take advantage of the economic recovery to come.
Yeah, thank you, Joanne. Hey, I appreciate so much your time. You want to make me the host again, and I'll
You betcha.
Share with everyone here.
All yours.
Okay. All right. Great. Thank you so much. So my main takeaways here with Dr. Feeney is that, again, they buy individual stocks for portfolios. That is huge. I mean, most money managers don't do that, which is when I found them a few years ago. I was so excited to see that because when they buy individual stocks for you, they're much more nimble in the markets as far as when to go in and out. And as she just went over here today, the advantages that you can take, that you see in different kind of markets that confront us. So they're nimble about doing that. The fees are lower as well. When you own a mutual fund portfolios, you have 12b1 fees in all the mutual funds that you own. So that's extra fees that me, Joanne, and ACM feels like clients don't need to be charged that. So the fees are much lower. I love how Advisors Capital does not panic during volatile markets. You have a plan, you stick with it, you adjust portfolios certainly as you see fit, but that's amazing to have that on your platform and really take advantage of that. So with that, I want to leave you guys with the evaluation form again. Oops, I need to do this. Sorry, Joanne, I got to share my screen again. I forgot. Let's see, let me go here, evaluation form. Okay. Oops, I'm messing this up big time. Let's see. There we go. Can we see that, Joanne?
Nope.
No? Okay. Well, I'm just going to go back to the screen here. I'll stop share. Oops, maybe I'm not going to stop share. Well, okay, well, I guess I'm not going to stop share. Anyway, so thank you, everyone. I appreciate you being on the call here. Thank you, Joanne. So appreciate your help with all of this and informing my clients what's going on in the markets and their portfolios. And stay safe out there. We will all talk to you soon. So thank you again, Joanne. I really appreciate your help.
My pleasure. Yeah, you stay safe too. Enjoy that nice warm California sunshine for me.
Absolutely. Okay.
Okay.
Take care now.
Take care.
Bye.
Yep. Bye.